How does an idea to sell snowboarding equipment snowball into a multi-billion-dollar business? Just ask Tobias Lutke, creator of Shopify. In the early 2000s, Shopify helped foster a dropshipping craze that has made countless people endless amounts of money. But while the company recently reported it had 1.7 million small businesses using its platform, its stock price has been sinking fast. That's why it's time to peel back the layers of this bustling business and see what's really behind the rise and potential fall of Shopify. Want to know more secrets about some of the richest companies and CEOs in the world? Like and subscribe to our channel. When you think about the way our fast-moving, ultra-globalized economy works, dropshipping sort of makes sense. After all, if companies like Walmart and Adidas can make billions selling Chinese-made wares at American prices, why can't anyone? It's a good question, and it's one that Shopify helped answer for millions of people. Though the company didn't necessarily invent the concept of dropshipping, it did perfect and package it for mass consumption. With dropshipping, you can make excellent money without ever having to handle stock or manage inventory. That's because you're not a store, but merely a storefront. You attract the buyers and make the sale, and the supply chain does the rest. If it sounds pretty tempting, you'll understand why Tobias Lutke and his partners didn't stop at owning an online snowboarding equipment store. Chapter 1. From Boards to the Boardroom. Tobias Lutke was born in Koblenz, Germany in 1981. At age 6, his parents gifted him a Schneider Color personal computer. Within a few years, he was rewriting the code of some of his favorite games. As a teen, Lutke dropped out of school to become a full-fledged computer programmer, but his aspirations were put on hold when his family relocated to Canada. The Great White North must have had an effect on Lutke, because as an adult, he partnered with Scott Lake and Daniel Wienand to start an online snowboarding shop called Snow Devil. Out of dissatisfaction with the available e-commerce solutions, Lutke developed a unique open-source framework for their store. However, the trio soon realized that the platform they'd created had potential well beyond snowboards. You see, Lutke had accidentally developed a fully customizable, easy-to-use storefront that allowed virtually anyone to sell and promote online. By 2006, this idea had officially grown into Shopify was basically a set of tools to help merchants build their own sites. It contained store templates, allowed for order tracking, and featured automated inventory management. After struggling for a few years, the team evolved their business model. More specifically, they decided that rather than take a percentage of merchant sales, they would operate on a subscription basis. Suddenly, merchants of all sizes were actually incentivized to sell more. This, it seemed, opened up the metaphorical floodgates, and people began to sign up at a fever pitch. In the coming years, smart management decisions helped Shopify grow while other web-based businesses were shrinking. They redesigned their platform based on merchant feedback, created an app and developer ecosystem, and went mobile-friendly. After a decade, the company was being used by more than 10 million sites, had gone public, and had made Tobias Lutke a billionaire. But as we'll see, this success may prove short-lived. Chapter 2. The Duality of Dropshipping. Shopify was intended as a way for merchants to sell their wares more easily. However, as with any other tool, there will always be those who find a secondary use. In fact, by the late 2010s, Shopify had evolved into the undisputed global leader in dropshipping. Indeed, most people will remember the years when you couldn't go on YouTube or visit a website without someone telling you about the millions they were making dropshipping electronics, apparel, or other goods. But while dropshipping is not inherently bad, people soon realized they could anonymously sell low-quality products at inflated prices, sourcing them directly from Alibaba or some other lackluster third party. These merchants never had to see the products, never had to evaluate their quality, and, in most cases, never had to handle a single customer complaint. Dropshipping soon became synonymous with cheap, off-brand items. Unfortunately, wherever you saw someone dropshipping, you also saw Shopify. In October 2017, Citron research founder Andrew Left released a report to the Federal Trade Commission in which he called Shopify a get-rich-quick scheme. he claimed there were hundreds of thousands of unverifiable merchants using the platform with minimal oversight. This represented the first time that the company's stock took a major hit, but it would not be the last. Shopify's reputation for legitimate merchants into the primary tool of back-alley merchants looking to make a quick buck. Chapter 3: Trouble in Paradise. Despite being as synonymous with online product scams as it was with legitimate website services, Shopify remained extremely popular. The company's app store contained more than 3,000 apps. It had around 10,000 employees. It enjoyed a roughly 20% e-commerce market share. In short, Shopify was doing just fine. Around 2019, the company was advertising across tons of platforms, including television, podcasts, and most notably, YouTube. In fact, dropshipping ads enjoyed one of the highest CPMs on the site. To this day, you can find thousands of YouTube videos telling you how to turn 60 minutes a day into a six-figure side hustle using nothing but a Shopify account and a Facebook page. And as interest in dropshipping grew, more and more people entered the marketplace, inflating the metaphorical bubble surrounding the industry. Then 2020 arrived, bringing the C-19 situation with it.
Declaring a state disaster.
Fort Worth Mayor Betsy Price is expected to announce a stay-at-home order.
All is going to move to a safer home.
Increasing numbers of COVID-19 infections in its population.
The virus causing this disease is known as severe acute respiratory syndrome, coronavirus 2. The disease spread.
In no time at all, tens of millions of people were stuck at home, many with no or limited income. Suddenly, those how-to-make-money dropshipping ads seemed much more appealing. In April and May of 2020, searches for Shopify doubled. People all over the world began signing up for the platform en masse. What's more, investors took note of the site's increased popularity and began putting unprecedented amounts of money into the stock. In just a few months, the company's stock value went up 500%. Of course, this is all great news, right? Well, it would be if Shopify had a more traditional business model. But because it relies on subscriptions and transaction fees for income, the company's success is intrinsically tied to the success of its users. And unfortunately, dropshipping is not the get-rich-quick scheme many pandemic entrepreneurs were hoping for. Stats show that around 90% of dropshippers quit within a month. Those who stick around have to deal with a very volatile income stream, switching back and forth between feast and famine almost weekly. It suddenly became clear to investors that they had entered a fully unsustainable bubble, and since the stock was currently hypervalued, the only thing they could do was get out while they could still make a profit. That's when the selling began. So far this year, Shopify's stock is down a whopping 80%. After reaching an all-time high of $169 per share in November of 2021, the stock is now trading around $29 per share, lower than it was in the months leading up to the pandemic. To put it simply, the bubble has burst. Now, not all of this is Shopify's fault. In fact, one could argue that Lutke and his team had very little to do with the drop at all. While they certainly leaned into dropshipping as a concept, they had no control over whether or not their sellers are successful or not. What's more, they couldn't have predicted the pandemic any more than the other thousands of businesses that failed due to the C-19 fallout. But regardless of who's to blame, the effects are still there. The stock value has plummeted, stores are experiencing minimal growth, and the company has had to lay off around 1,000 employees. Inflation and supply chain issues, also the result of the pandemic, only made things worse for both legitimate sellers and dropshippers. On top of that, consumers are being stretched by commodities costs, which are now further being affected by the Russian situation in Ukraine. And while debate rages as to whether or not the US is actually in a recession, much of the rest of the world is. And that means fewer people launching stores and even fewer looking to buy from anywhere but the cheapest possible source. All of this paints a picture of a company in peril. This is all made worse because the company's very business model relies on merchant activity and, to a greater extent, merchant success. However, Shopify can't force people to keep their stores open. They can only incentivize them to do so. And so far, nobody, including Lutke, has any ideas what those incentives should be. Chapter 4: The Future of Shopify. But while there's no denying that Shopify is currently in decline, they aren't exactly out of the game. The company's 2021 revenue was $4.61 billion, which is more than enough seed money to keep it going for years to come. What's more, most investors are bullish on Shopify, expecting it to enjoy another growth cycle as soon as the global economy stabilizes. Hopefully, this time, that growth will be slower and ultimately much more sustainable than the slingshot effect spurred by the pandemic. Lutke and his team are still advertising across multiple media, with a huge focus on YouTube. Though ad views are declining, they have managed to forge some major partnerships with YouTube personalities like Mr. Beast. If successful, these efforts could help Shopify reverse its current course and eventually manufacture growth once again. Unfortunately, Lutke and the Shopify team seem to have a bigger target in mind: Amazon. Indeed, the real risk to Shopify has nothing to do with stock prices, merchant retention, or investor goodwill. It has to do with the site's desire to take on the largest company in the world. Rather than focus on innovation or implementation of NFT or Web3 technology, Shopify wants to build out its own distribution network and take on the Amazon machine. It's not that far-fetched, as Shopify is already the second most dominant global e-commerce player. However, experts doubt whether the company is currently in the position to challenge such a worthy adversary, or if it ever could be. At its current valuation, experts feel Shopify is more likely to be bought out and absorbed by Amazon than to become a real contender. But the Shopify management is not backing down. According to VP of Product Glenn Coates, "We will go wherever the world of commerce goes. We want Shopify to be a big, easy button." Though only time will tell, it's possible Shopify is about to find out just how not easy things can get.